That rush, you see the chart spike. That little meme coin you bought on a whim, maybe it was Shiba Inu, maybe Doge, or the latest one trending on social media, is suddenly up 50%. You sell. A quick tap on your phone and boom, $400 in profit appears in your account. It feels like magic. Free money, right? You do it again the next day, and the next. Maybe you're not just flipping meme coins, you're staking some Ethereum, earning yield on a DeFi protocol, or you just got a surprise airdrop from a new project. Your portfolio is a complex web of assets, constantly moving, constantly changing. Those small wins are adding up, and the numbers on the screen look good. It's the wild west of finance, and you're navigating it like a pro. You're making money while the traditional markets are sleeping, but in the back of your mind, a small question starts to linger. A question that gets louder as tax season approaches, and that question is, what about taxes? Here's the hard truth the crypto world is waking up to. The Internal Revenue Service, the IRS, doesn't see the magic. They don't care if your gains came from a sophisticated trading bot or a coin with a dog on it. To them, it's not a game, and it's certainly not free money. They want their cut, and they are getting much better at taking it. For years, many in the crypto space operated in a gray area, assuming the taxman couldn't track their decentralized activity. That era is definitively over. The IRS has invested heavily in blockchain analytics tools and has made it crystal clear that crypto is a major enforcement priority. You've probably seen the question right on the front of your 1040 tax return. At any time during the tax year did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? Answering that question incorrectly, whether intentionally or not, can land you in a world of trouble. We're talking audits, steep penalties, and back taxes with interest that can wipe out your gains and then some. The core issue is that the IRS classifies cryptocurrency not as currency, but as property. This single designation has massive implications. It means almost everything you do can trigger a taxable event. Selling crypto for dollars? That's a taxable event. Trading your Bitcoin for Ethereum? Taxable event. Using your crypto to buy a pizza or an NFT? You guessed it, another taxable event. Each one of these requires you to calculate your capital gain or loss. Now, if you've only made a handful of trades, that might sound manageable. But what if you're a day trader? What if you have thousands of transactions across multiple exchanges and wallets? How do you calculate the cost basis for crypto you earned from a staking pool 2 years ago? It can quickly spiral from a simple math problem into an overwhelming, anxiety-inducing nightmare. That gain you were so excited about can morph into a massive tax headache. But it doesn't have to be that way. In this video, we're going to demystify the entire process. We're going to turn that chaos into clarity. We'll break down everything a US-based crypto trader needs to know. We'll cover how to calculate your capital gains and losses, the critical difference between short-term and long-term rates, and how to accurately determine your cost basis using methods like FIFO and HIFO. We'll show you how to consolidate your transaction history from every exchange and wallet, and explore the software that can automate this entire process, saving you hundreds of hours. We'll even dive into advanced strategies like tax loss harvesting to legally reduce what you owe. This is your step-by-step guide to conquering crypto taxes, ensuring you stay compliant, and keeping more of your hard-earned profits. So stick around, because we're about to transform that potential headache into peace of mind. Every trade you make, even in a meme coin, is a taxable event. Gains, losses, and even swaps between coins can trigger reporting requirements. And yes, the IRS is tracking crypto wallets. Step 1. Download your transaction history from every exchange you used. That includes buys, sells, swaps, and transfers. If you use DeFi or DEX platforms, export that data too. Step 2 is where you leverage technology to conquer the chaos. Import your data into a dedicated crypto tax software. For active traders, this isn't just a convenience, it's a necessity. Manually tracking thousands, or even tens of thousands of trades across multiple exchanges, wallets, and DeFi protocols is practically impossible and prone to costly errors. Platforms like Koinly, CoinLedger, and TokenTax are built for this exact purpose. Your first task is to create a complete, unified record of your entire crypto history. You'll connect your exchange accounts using API keys, which allows the software to automatically pull in your trade history. For exchanges that don't support APIs, or for your on-chain wallet activity, you'll export your transaction history as CSV files and upload them directly. The goal is to feed the software every single piece of data from every source you've ever used. Missing even one wallet or an old defunct exchange can lead to inaccurate calculations and serious reporting issues down the line. Once your data is in, the real magic begins. These tools automatically process every transaction to calculate your capital gains and losses. The cornerstone of this calculation is your cost basis, what you originally paid for an asset. The software meticulously tracks the cost basis for every coin and token you own, even across different wallets. Crucially, these platforms allow you to apply different accounting methods to see how they impact your tax bill. The IRS's default method is first in, first out, or FIFO, where you're assumed to sell your oldest assets first. In a rising market, this often leads to higher capital gains. However, for traders, a more powerful strategy is often highest in, first out, or HIFO, a form of specific identification. HIFO allows you to sell the assets you acquired at the highest price first, which can significantly reduce your taxable gains or even generate capital losses to offset other gains. The software lets you model these scenarios instantly, transforming a complex tax optimization strategy into a simple click of a button. But importing isn't the final step. Now comes the critical process of reconciliation. The software is smart, but it isn't psychic. It will often flag transactions it doesn't understand, and it's your job to provide clarity. A common example is moving crypto between your own wallets. The software might initially see this as a withdrawal and flag it as a potential sale. You need to go in and classify these as non-taxable transfers. You'll also need to properly categorize income events. Was that incoming transaction an airdrop, a staking reward, a payment for a service, or a gift? Each one has a different tax treatment, and correctly tagging them is essential for an accurate report. This reconciliation phase is the most hands-on part of the process, but it ensures the final report is bulletproof. Rushing this step is one of the biggest mistakes traders make, as it can completely undermine the accuracy of your tax forms. After you've imported, reconciled, and selected your accounting method, the software generates the official documents you need to file your taxes. The primary document is IRS Form 8949, Sales and Other Dispositions of Capital Assets. For a day trader, this form can be hundreds of pages long, detailing every single trade you made throughout the year. The software populates this form for you, line by line. It also generates the summary totals needed for Schedule D. These platforms provide several export options. You can download a completed Form 8949 as a PDF to file with your return or provide to your CPA. Even better, most offer a specialized file that you can directly import into popular tax filing software like TurboTax or H&R Block, automatically populating all the necessary fields. This seamless integration bridges the gap between your complex trading activity and the standardized requirements of the IRS, saving you countless hours and giving you peace of mind that your reporting is comprehensive and accurate. When it comes to crypto taxes, one of the most critical factors that can dramatically change your tax bill is the holding period. This is simply the length of time you own an asset, like SHIB, before you sell or trade it. The IRS has very different rules for assets held for a short time versus those held for the long haul, and understanding this distinction is fundamental to smart tax planning. The clock starts ticking the day after you acquire the cryptocurrency and stops on the day you sell it. Let's break down exactly what this means for your wallet. First, let's talk about short-term capital gains. If you hold SHIB or any crypto for 1 year or less, any profit you make is considered a short-term gain. The IRS treats these gains just like the income you earn from a job. This means they are taxed at your ordinary income tax rate. These rates are progressive, meaning they increase as your income increases, and for 2024 they range from 10% all the way up to 37% for the highest earners. For active day traders, this is especially important, as most of your profitable trades will likely fall into this category, subjecting your gains to the highest possible tax rates. Let's walk through a quick example. Imagine you buy $2,000 worth of SHIB. 6 months later, the price has gone up, and you sell it for $3,000. You've made a $1,000 profit. Because you held it for less than a year, this is a short-term capital gain. Now let's say your total taxable income for the year, including your regular job and this gain, places you in the 24% federal income tax bracket. That means you'll owe the IRS $240 on that trade alone, not including any state taxes. This is how quick flips can lead to surprisingly high tax bills if you're not prepared. But what if you hold on longer? This is where the magic of long-term capital gains comes into play. If you hold your SHIB for more than a year, that's 1 year and 1 day, to be precise, your profit now qualifies for preferential treatment. The government incentivizes long-term investing over short-term speculation by offering significantly lower tax rates. These long-term rates are 0%, 15%, or 20%, depending on your total taxable income. For 2024, a single filer with a taxable income up to $47,025 could pay 0% on their long-term gains. Yes, zero. Most people fall into the 15% bracket, which for a single filer applies to income between $47,026 and $518,900. The highest earners, with income over that $500,000 mark, pay 20%. The difference is substantial. Let's revisit our example. You bought $2,000 of SHIB and made a $1,000 profit, but this time, you waited 13 months to sell. That $1,000 is now a long-term capital gain. Assuming you're in that same 24% ordinary income bracket, you won't pay $240. Instead, you'll likely pay the 15% long-term rate. Your tax bill on that trade drops from $240 to just $150. That's a $90 saving or 37.5% less tax, simply for holding the asset for a longer period. This strategy, known as aging your lots, is a cornerstone of tax-efficient crypto investing. Now, for higher income traders, there's one more layer to consider: the net investment income tax, or NIIT. This is an additional 3.8% surtax on investment income, which includes crypto gains for individuals with a modified adjusted gross income over $200,000 or $250,000 for those married filing jointly. This tax applies on top of your capital gains tax. So, if you're in the highest bracket, your 20% long-term rate could effectively become 23.8%. If it's a short-term gain, your 37% rate could become 40.8%. It's a crucial factor for successful traders to account for in their planning. So how do you manage this strategically? By carefully tracking your purchases. When you sell crypto, you need to identify which specific coins you're selling. If you don't, the IRS defaults to a first-in, first-out or FIFO method, assuming you sold the first coins you ever bought. However, if your broker or software allows for it, you can use specific identification. This lets you choose which lot to sell. For example, if you bought SHIB in January and again in December, and you sell some the following February, specific ID allows you to sell the January lot to lock in long-term gains, while continuing to hold the short-term December lot. This level of control is a powerful tool for tax optimization. The key takeaway is that time is money, quite literally. Your holding period is the switch that determines whether you pay top-tier ordinary income rates or much friendlier long-term capital gains rates. Step 3. File your return with the crypto forms attached. Keep all records for at least 3 years, in case the IRS comes knocking. Meme coins can make you money, but taxes can take it just as fast. Subscribe for moonshot tactics, and in the next episode, the only tax strategy you need for your next Bitcoin moonshot.